Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. On today's show, I brought on a special guest, Joe Cecala. Joe is the founder and CEO of the DreamX, a stock exchange designed for the free trading of small business stock through a fully licensed and operational stock exchange. Joe, welcome to the show.
Thanks, Mark. It's great to be on.
Maybe you can start off by telling us what DreamX is and why did you decide to create it?
Sure. Well, those are two big questions. So what DreamX is, Dream Exchange, we're still in formation. We're not licensed yet, but we're forming a national market system exchange to be of equal, competitive nature to NYSE, NASDAQ, but probably more relevant to to the audience today is our kind of special purpose, which is our research team and myself included have been primarily responsible for creating a new law. Well, it's not law yet, but it's moving its way through Congress called the Main Street Growth Act. And that will form a brand new type of stock exchange called a venture exchange, which allows for liquidity and secondary liquidity for emerging company stocks, but they have to go through the exact same transparency and due diligence and vetting process that they would to list on a larger exchange. The unique nature of what we're doing is, it's a brand new piece of federal legislation editing the 1934 Securities Exchange Act that allows for early stage investors to have an increased menu of investment choices that they ordinarily would never even see, but also to do it with substantial investor protections that are customarily unavailable if for a private company investor. They just don't have the resources of a large VC to go and examine a company and assure that its valuation and its diligence and its operations are fully in place. And it's very different than the over-the-counter market because many of those companies don't have any diligence process as they would if they were approaching a genuine, full-blown stock exchange like us.
Maybe we can take an example on both sides. Let's say a business. How do they come to the exchange and get listed on the exchange? And then also that early stage investor, and how do they go about, or how do they have the ability to go then and pick and choose kind of which of these companies they're interested or want to invest in?
Sure. The business line, the listing what we call the listing candidate line, we're actually developing that market today, even before we're open. And that's a significantly more complex question because what we're doing is evaluating the early stage company for eligibility. And we haven't published our rule book yet, but our research, we've actually hand gathered over 1,600 successful early stage companies that have gone through the public markets and graduated to national exchanges. So we're gathering the data on those companies to assure us that when we perform our due diligence and create new early stage company listings, that the probability of success for that organization is very high. We've actually published a white paper. It's chapter 9 of the Oxford University Handbook on IPOs. So I'm the author of that with our director of research. The early stage company that may want to come to our exchange, it can be any company anywhere that's in its infancy. We literally will probably be going down to as low as a $5 million capital raise for an IPO. But it will be a full-blown, fully compliant initial public offering. And for the companies out there, one of the educational processes that's missing is what does it take to not only be a public company, and then there's a lot of confusion amongst the serious financial professionals that I talk to, the difference between a registration of your securities with the SEC. You can register securities and you can sell them to anybody. The problem is you may not be eligible to be listed, which is different from a registration. A listing on a stock exchange eligibility is very different. So what we're doing is we're bringing the registration and listing into the small cap markets with the proper financial reporting, transparency, due diligence, and educating the small company owner as to how he maintains that going forward. So there's a trustworthy investment market. So that's on the entrepreneur side or the early stage company side. We're cultivating the network of people. We actually have a social media site called DreamX Connect, where we probably have about 2,000 entities in there right now. So there's an entire process with a team of people that are working on our rule book for the entrepreneur. Now, for the investor, this is close to 30 years of my being in capital markets and representing a lot of VCs and angel investors, and that's been my audience for my career. And I found a common question with all private investors. And the common question is, I love this company. I want to invest my money. I think they're great. Thank you for all the due diligence. The contract looks wonderful. How do I get out? What's my exit? And when you make a private investment, essentially you're in for the long haul. You can't resell your shares once purchased in a privately held company. So the customary way that an investor gets his money back is, and today it's more prevalent than ever before, which is total sale of the company. They have to exit to BigCo. They've got to sell to a larger organization, or sometimes they sell to a private equity firm. But the exit is very often a complete liquidation of the investment, which for the early stage investor may not necessarily be optimal. Remember, there's the founder and there's the angel investor, and then there's the second and third round of VCs, and they all tend to be in the soup, and they all have different goals, and they all have different objectives, and they all have different ideas about whether they want to stay in or leave. It applies across the board. It applies to real estate limited partnerships, and some people want to be in, some people want to be out, but it has to be kind of unanimous. So in our market, with a bona fide secondary market liquidity market for early stage investments, the listing of that company's shares allows each individual investor to make a self-determined decision. In other words, they can sell their shares just as they would with any publicly listed company for any reason or no reason at all. They get to freely choose whether they've optimized their IRR, whether they analyze the company's future and decide they want to have a total liquidation event or partial. They can recapture some of their investment by selling a portion of shares. It's exactly like you would make an investment in a large cap company on a major exchange. The difference is that the listing and the diligence and the transparency and the regulatory investor protections are all in place so that when we're listed, that early stage investor is adequately protected. But how will they go about doing it? Exactly the way that they would go about doing it on the big board. So, through their accounts at whatever brokerage that they hold their securities trading account, if you're at E-Trade or any investment app that you're linked to a brokerage, there'll be a separate menu of listings that'll trade on our exchange. And that menu allows you to view all their Edgar filings, view all their due diligence materials, and be able to choose to make your investment. And then as continuous reporting goes on, you can choose to sell or you buy more. It'll be exactly the same financial technologies that are used for large cap companies on major exchanges.
Who do you see, this early stage investor that we're talking about? Do you see this as venture capital, private equity firms, or do you see it as maybe someone who makes a lot of money and the same way they might want to buy Apple stock, they want to come in and buy shares of a private company, or maybe a combination of both of those?
It's a combination of both. And what's very interesting is when we really were pushing the Main Street Growth Act early on, which is going back 5 years ago, I was pleasantly surprised that the American Venture Capital Association and the VC groups really were supportive of the legislation because they have PE firms have portfolio companies and they're good companies and they can't optimize their valuation. They're in a strategic relationship where they're looking for their own exits. So the investment pools are very interested in this type of exchange because it does two things for them. One is it gives them a listing platform that isn't necessarily the unicorn multi-billion-dollar IPO, but it's a good company. It might be a 15 or a 20% IRR, which is, those are good numbers. A successful enterprise and a successful exit. Well, they currently do not have access to the American public markets. So the large investment pools and funds are interested. That's one reason. The other reason is it gives them an opportunity to supplement their fund. In other words, let's just say a VC has $500 million in his VC fund. He can now choose to amplify the fund by making less of a VC investment, but using the public capital market to supplement maybe he's going to take a 20 or 30% interest in the company, but he might need a syndicate of other VCs to round out the capital raise. Well, now he can approach the public capital markets, doesn't necessarily have to partner with other VCs or angels. He can just use this as a amplification of his funds. So that's the funding pool motivations. Yes, high net worth individuals. This is the really surprising result for me over the last 5 years. There is a vast number of high net worth individuals, accredited investors, really qualified investors, and qualified in two ways. One is that they meet the accredited investor standards and are ordinarily making these investments, because to do a Regulation D offering, you have to be accredited. By the same token, there are what I would call sophisticated investors who may not meet accredited standards, who can go to a retail market and side by side themselves with VCs and a public offering, which they can't do today. So for those investors, it really opens up the market to choice. It gives them a menu and access to the earlier stage company. So the earlier you're in and the more wealth creation there is, because you got in early, chose wisely, chose an industry or a marketplace that you're perhaps an expert in, and you can really identify, early stage technology and products that are going to grow. Then you can make, as a sophisticated investor, choices to acquire smaller portions of the same company. In other words, there's no minimum, as there might be in a private placement. So it really opens up the market to the entire investor category. And it does so in a trustworthy way. This has been of vital importance to us, because we have to have a good market. We have to be very disciplined about getting excellent companies with good products that are transparent and willing to report. Or we won't have a market. If we can't have, sorry for this derogatory expression, but we can't have a bunch of dogs with fleas. We've got to have pedigree companies that can do well. So that's on the investor side. It goes across the board from those who have raised funds to the individual investors, family offices. When we launched with some major press releases about a year ago, we had over 1 million visitors through our website in short of 2 months. And we've been able to do a lot of surveying of that public and see what they're really thinking and what their interests are. And we're tailor making the marketplace to accommodate the needs of the American investing public. This is the other thing. This is the cherry on top. At one time, 65% of American households directly owned a security. They were directly invested in the marketplace and had a portfolio of stocks. And fewer than 18% of the households directly own a stock today. It's always a vehicle. So it's, an ETF or a mutual fund or through a 401k plan. And so there's always a fund manager controlling the population of investments within portfolios of those companies. And this is a truly democratization of how public capital markets will work. They can then isolate things and industries and companies that are really growth potential and choose to make smaller investments in more companies and create their own portfolio internally. And that seems to be what the flavor of the investing public is today. There's a lot of very valuable ETFs and fund management organizations. However, if you go out of the ETF market, now you're looking to join pools of other investments. You want to be a limited partner in a large group because it gives enough capital to get a transaction done. Well, very similarly, this is a marketplace that opens the market to a broader audience of companies so that those investors don't have to just side by side themselves with a bunch of limited partners and just, acquire one strip mall. This opens the marketplace to a company that has purpose, is a going concern for a longer term, but doesn't lose sight of the fact that secondary liquidity is of vital importance to the investor. They have to be able to choose when and how they exit the investment profitably.
The investor will have the option, if they come onto the platform, they'll have the option of looking at a company maybe that's IPOing, but also there's going to be a secondary market where they have the option to purchase shares in a company, that's gone public already on the exchange, but someone has sold their shares of them.
Yep, it's exactly right. And we're considering the nomenclature. I wasn't a big fan of the term venture exchange because it sort of isolates it to purely venture capital. And a lot of the companies we see they're not really necessarily venture capital investments. They're operating companies. They have strong earnings. Products that go into the chain of products in their industry, and they're privately held. So the difficulty there is if they want to raise capital to expand, that's one feature of the market. On the other hand, once they've done their IPO, which would be on the national exchange, these will probably be called IVOs, so initial venture offering. It's a brand new type of security as well in the law. It's called a venture security. It's a completely new type of investing, and that IVO allows you to get in at the red herring price when it goes public, and then there's a daily or a weekly. We can customize the rules for when the auctions happen. If it's a really small company with low volume, they may only auction once a week. It's not necessarily a continuous trading market, but once a week is a lot better than you've made a private investment you're in forever. So yes, the secondary market I think is going to become of vital importance. And like I was talking about our research shows that there's a gap between the venture market and the IPO market, because IPOs generally today have to be very high volume, very high valuation, in fact, multi-billion-dollar valuations in most instances. So this restores the volume of really good small company IPOs in a customized market and allows for the freedom of choice in a secondary market. Like I said, you can choose to sell for any reason or no reason. Over my career, it's funny because these are literal stories. I had people invest $100,000 in a small company. Company's doing great, expanding, flourishing. And then I'll get a call from the investor saying, my kid's going to college. I want to put a new deck on my house. My wife wants a swimming pool. Now I'm in this conundrum where it's a very healthy, profitable, nothing wrong with the company, but now we've got to go on a secondary capital raise to liquidate the investment. And then you get into a valuation discussion, right? Because that $100,000 investment, maybe worth $3 million. Now you got to raise $300,000 to find a replacement investor to recapitalize the company. There's a lot of legal work. There's a labyrinth of legal documents for a secondary placement of a primary placement of a private offering. It's super complex. This market eliminates that. So companies listed, if your kid wants to go to college, great. You check pricing and you've got free market valuation because share pricing will be in a public market. So there's no debate on that. And you decide how much you want. And maybe you don't need all of it recaptured, but you need a sufficient amount to live your own life and be self-determined. So it's a really neat marketplace. I'm really looking forward to launching. We should hopefully launch by the end of the year, early next year. We should get the doors open.
You mentioned the liquidity or even lack of liquidity on some private investments. Now, I think that scares off some investors because they want to have control. They understand it's not as simple as just going into their brokerage account and click and sell with a private investment. But they also don't like the fact being told that your investment is indefinite or whenever, there's some kind of liquidity event. I think the other thing that DreamX sounds like it solves is it seems nowadays companies are holding off on IPOing. And what they're doing is they're sucking a lot of that early growth up front. So when they do IPO, it's not the same as it used to be where, the company would double its revenues or triple its revenues in the first couple of years. Now they're almost a mature company when they're IPOing. So the ability to, do an early stage investment, I think is something that's lacking right now.
Yeah, those timelines have expanded dramatically for the companies that do eventually even make it at all to the IPO marketplace. It's approaching 8 years from receipt of their first venture dollars. And that used to be somewhere in the 36 to 48 month range. So we've doubled the time to market for IPOs. We have a lot of webinars and YouTube educational videos that show the problem is really in the 50 million and under IPO marketplace. At one time, between 70 and 90% of all initial public offerings were $50 million and under. And that's normalized for today's dollars. And we would have anywhere between 600 and 800 transactions per year. Now we're lucky if we have 200 transactions and less than 20%, sometimes as little as 10% of those are 50 million and under. So the marketplace has dramatically changed because of financial technology over the last 20 years. I kind of feel responsible for that because I was the lawyer for the founding group of Archipelago. ArcaX actually merged with the New York Stock Exchange in 2005. And, high-speed electronic algorithmic trading dominates the public capital markets. So if you got a small company that has low volume, it's of virtually no interest to the national public markets. They can't make any money. In other words, well, they can make money, but let's put it in the context. If you have a $1 billion IPO and it maps pricing-wise into its IPO over the course of the first year, there's nominal IPO expansion. That gobbling up that you talked about of the early stage companies' wealth creation isn't really available through the IPO market. But there's high volume because it's a huge company like Uber or LinkedIn, Zynga, the big IPOs of the past. So volume has driven the revenue model for the investment banks and the exchanges. So what we're doing is we're shifting our revenue model around so that we can also be profitable as an exchange. We're actually lowering the cost and barriers to go public, but also it's made up for in the wealth creation because you're in early. You never hear this anymore. In the 80s, you hear it all the time. I want to get in early on that IPO. That just doesn't, that kind of talk doesn't exist. There's not guys with the Wall Street Journal under their arm and a bagel running into the brokerage firm to find the next new public company. Those guys now live in private equity halls and VC firms, and the rest of the American investing public really doesn't have the opportunity to have access to those investments anymore. So we're opening that market.
The companies that are going to list on the exchange, do you see them as at some point they graduate to one of the national or larger exchanges, or do you see them staying permanently on your exchange?
That's our plan. So the graduation plan is absolutely within our cards. That's why we're forming a national exchange to begin with. So we want to see broad venture security market, not venture capital market, and get substantial numbers of small candidates that trade and then see those companies graduate to a national exchange. Written into the bill, there's actually limitations. So once a company reaches a $2 billion market cap, they have 12 months to graduate to a national exchange. And so it's not tiny companies, it's just smaller companies. And I think a $2 billion market cap gives them plenty of time. If they start out, our pilot company that we worked on 12 years ago, they started out with about an $80 million market cap when we took them public. It was an over-the-counter company. And when they graduated to the NASDAQ, they had about a $200 million market cap. So they doubled in value, more than doubled in value over a 36-month period. Early stage investors were really happy. The private investors that went public with us got 7x. So it was a model that really works if you're an astute early stage investor. 7x in 4 years is, that's venture capital style returns. Yet they were not in a venture capital investment. I mean, you would not have considered the company. It was a very boring electronics company. They were actually a manufacturer of dry type transformers. Doesn't get less sexy than that, but a stable 11% IRR year after year. The company had been around for 70 years. They needed capital to expand. When they got the capital from the over-the-counter, we did a PIPE transaction. So, it was only a $5 million transaction to get them public. And those early stage investors acquired at about $1 a share. And when they graduated to the NASDAQ, I think they were at $11 a share. So they were in a free, open public market in the Russell 2000 and with, 4,000 investors and many mutual funds that had acquired them. So there was a secondary liquidity market for something where, maybe the early stage investor only wanted to harvest, 20% of his shares, but he'd already made his money back and then some, and he was still holding a very nice part of his portfolio in a then existing public company on a national exchange. So graduating is absolutely within the cards, and they don't have to be $2 billion when they graduate. Yeah, I think that the market we have will likely see companies graduate earlier than they have in the past, because the excitement around some of these companies will be high, and they will get faster to the $2 billion market cap in valuation, in spite of the fact that they may not be growing revenues or profitability. Tesla is a perfect example. I mean, Tesla didn't make money until July of last year, but somehow they were among the fastest growing market caps of any public company. Well, why is that? They had the technology to make long distance travel in an electronic automobile workable, and they made the retail pricing of the automobile pristine. So if you can do that, you have an extremely valuable company, in spite of the fact that you might not be having huge dividend checks cut to your investors, because the future for that marketplace is huge. And a lot of people speculated in the stock. They made their money. There's a lot of long-term people who have stayed in Tesla, have large holdings of that portfolio. So, and that's a big model. That's like a very gross example, but there are a lot of smaller companies, perhaps with less multiple, that are very similar to what Tesla had. That's what we're going after.
You mentioned earlier about the decreasing percentage of people that own individual stocks or securities. And while I think there are a lot of people that do want that full control to being able to select, there are probably a lot that also like being able to have a fund manager or an index or an ETF where they can kind of have someone else do the due diligence or do the research. Or do you see funds, whether it's like your typical mutual fund or indexes, built off of these companies that are going to be on the exchange?
Yeah, and that's actually parallel to what we're creating. So right now, not only is it that there's no secondary liquidity for your average private investor, but there's a total prohibition on funds being able to make these private investments. So once eligible for a listing on an exchange, now you make the availability of fund managers and analyst coverage open to the smaller company, which really will enhance the liquidity in the market. Because right now, like I said, there are no companies like this in an ETF. There is no Morningstar rating capabilities for, the small private companies. So it's a relationship-driven marketplace. And as we open the marketplace to really quality companies, and then they can be pooled. They can be pooled by industry. You can get indexes off of it. You can get a futures market off. It's a bit like mercantile exchange became such a huge marketplace. Without the basic commodity, without corn, there are no corn futures. Without cattle, there are no cattle futures. So what we're creating, the initial marketplace where the commodity of the trustworthy initial investment allows for analyst coverage and expansion of fund managers who can then look at this marketplace and have some prediction and have adequate statistical data and analyst data, so they know, if we invest across this industry sector on a venture exchange, we can tell you that there's going to be some range of IRR and some range of profitability, and they can make choices as to whether they have buy and sell recommendations on the industries that are within the venture market. So the venture market doesn't even exist. This is probably a little further down the road, perhaps 5 to 7 years, where the market is adapting itself to what the trading product is. But it's not new. It's how the S&P futures market was built. It's how the S&P was built. You have to first have, the 500 stocks to build the S&P 500. And that's going to be outside of our reach to some degree, but we'll be the data provider. We're the ones who own the market data that we will then collaborate with the analysts to get coverage on those early stage listings.
I think one of the things that scares off some investors from private companies, or even, whether it's a fund or some venture capital, is the lack of transparency, and it's just nervous from them. They hand over money and it kind of goes into a black box. You mentioned some investor protections earlier and some reporting. What will the individual investors get to see, or what protections will they have that they wouldn't have had otherwise?
That's a great question, and it's actually a very simple answer. There is no reduction in public filing transparency in this market. So it is a full-blown, fully compliant Form S-1 securities offering, as it would be if they were in the national exchange marketplace. The minor difference is there's a category of securities that will have some relaxed reporting, but the difference between the relaxed reporting today, so today there's relaxed reporting if you're, for example, an early stage or an emerging growth company, an EGC. So, you don't have to comply immediately with the Sarbanes-Oxley reporting. There's like a 2-year period by which you become fully compliant, which gives the early stage public company the opportunity to become fully compliant. So in that context, it's no different than it is if you invested in an EGC that went public on the NASDAQ. However, there's a category of securities which look a lot like, in the bill, this is in the Main Street Growth Act, they look a lot like what would be a Regulation A, Regulation A plus exempt offering, with one very distinct difference. Let's say you're going to make a private investment in a Regulation A exempt offering today. Well, it all depends on who the professionals are that are creating the transparency and have done the due diligence. And it's as different as there are Reg A offerings. What the exchange does is it provides a standardization, a minimum threshold by which we examine for eligibility standards what that former private offering looks like if it gets listed. So we have the ability to siphon out anyone who's not willing to be fully compliant with quarterly reporting, with audited financials, with the additional exhibits that are required in the financial reporting environment that are not necessarily required at all in a private offering. In fact, some private offerings, they offer a once a year option, and even that, like you said, they invest the money and they hear in 2 years that they've lost their money. This is a quarterly reporting environment, just as they would if they were a New York Stock Exchange listed security. If they fail at NYSE, they're delisted, trading is halted. There's all kinds of very immediate consequences because they're in the regulatory environment of an exchange. The SEC isn't policing that even. So if over-the-counter markets are fraught with problems because those companies, while they have to comply with SEC regulations for reporting, very often they fail. And, the over-the-counter brokerage market isn't an exchange required to assure that they're fully compliant reporting entities. On an exchange, by rule, to be licensed as an exchange, will require that they meet the listing standards every quarter. And if they fail, then there's exchange compliance, or regulatory exchange compliance, that prevents that company from continuing to trade or take money. So they have a tremendous incentive to be able to really push hard to keep in compliance. And, the duration of the investment is of great importance. In other words, if you did your IVO on January 1st and you were out of compliance by March 31st, it's very difficult in 90 days to, run a pump and dump or to do some type of shenanigans. So if you fail by March 31st, well, you're going to receive regulatory consequences and go into exchange compliance and be penalized. So right away, the investor protection, if you don't really intend to be a good market participant, this is not your market. And that is going to provide a tremendous amount of comfort to the trustworthiness of the investments to your general investor. And it will only be enhanced as the market grows, where analyst coverage and data from the companies is more readily available to investment analyst departments. So right now, getting analyst coverage at all is very difficult for small public companies. But when we customize the necessity to provide us with the transparent information, now we have a trustworthy, almost Morningstar type of database that goes out to professional investment analysts.
Yeah, I think that definitely will help with some of the comfort, like you said. Well, Joe, we're just about out of time. I want to thank you for being on the show today. How best can someone reach out to you, find out more about DreamX?
So info@dreamex.com. Dream, DREAMEX.com is our website. And the info@dreamex.com, that actually goes directly. I see those emails. We respond, senior management responds. So if you want to get in communication with us, send us an email. The other thing to look for if you wanted to connect up is DreamX Connect. So you can go through our website and all of the links are there. Those links to the legislation. There's all of our YouTubes and all of our media and, all the Fox News stuff that covered us. And there's a tremendous amount of data and lots of really great videos. We have a great marketing department. So all of the information that you can reach through our website at dreamx.com.
Great. We'll link to all that in the show notes. Joe, thanks again. And thank you everyone for tuning in today.
You're awesome, Mark. Thank you.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.